Michael Marcos. Blighting never strikes twice. Michael Marcos began his career as a commodity research analyst for a major brokerage house. His near-compulsive attraction to trading led him to abandon his salaried position to pursue full-time trading. After a brief, almost comical, stint as a floor trader, he went to work for Commodities Corporation, a firm that hired professional traders to trade the company's own funds. Marcos became one of their most successful traders. His profits exceeded the combined total profit of all other traders. Over a 10-year period, he multiplied his company account by an incredible 2,500%. The interview was conducted in Marcos' home, a two-house complex set on a cliff overlooking a private beach in Southern California. How did you first get interested in trading futures?
I was something of a scholar. In 1969, I graduated from Johns Hopkins Phi Beta Kappa, near the top of my class. I had a Ph.D. fellowship in psychology at Clark University and fully expected to live the life of a professor. Through a mutual friend, I met this fellow named John, who claimed he could double my money every 2 weeks, like clockwork. That sounded very appealing. I don't think I even asked John how he could do it. It was such an attractive idea that I didn't want to spoil things by finding out too many facts. I was afraid I would get cold feet.
Weren't you skeptical? Didn't he sound too much like a used car salesman?
No, I had never invested in anything, and I was very naive. I hired John, who was a junior at my school, to be my commodity trading advisor at $30 a week. Occasionally, I threw in free potato chips and soda. He had a theory that you could subsist on that diet.
That's all you paid him. Weren't there any profit incentives, extra potato chips if he did? Well,
Not at all.
how much money did you allot for trading?
About $1,000 that I had saved up.
Then what happened?
My first trip to a brokerage house was very, very exciting. I got dressed up, putting on my only suit, and we went to the Reynolds Securities office in Baltimore. It was a big, posh office, suggesting a lot of old money. There was mahogany all over the place and a hushed, reverential tone permeated the office. It was all very impressive. The focal point was a big commodity board at the front of the office, the kind that clicked the old-fashioned way. It was really exciting to hear the click, click, click. They had a gallery from which the traders could watch the board, but it was so far away that we had to use binoculars to see My first realization that things might become a little scary was when a voice came over the loudspeaker recommending the purchase of soybean meal. I looked at John, expecting to see a expression of confidence and assurance on his face. Instead, he looked at me and asked, "Do you think we should do it?" It quickly dawned on me that John didn't know anything at all. I remember soybean meal was trading quietly, 78.30, 78.40, 78.30, 78.40. We put the order in, and as soon as we got the confirmation back, almost mystically, the prices started clicking down. As soon as it knew that I was in, the market took that as a signal to start descending. I guess I had good instincts even then, because I immediately said to John, "We're not doing too well, let's get out." We lost about $100 on that trade. The next trade was in corn, and the same thing happened. John asked me whether we should do the trade. I said, "Well, all right, let's try." The outcome was the same.
Did you know anything at all about what you were doing? Had you read anything about commodities or trading?
No, nothing.
Did you even know the contract sizes?
No, we didn't.
Did you know how much it was costing you per tick?
Yes.
Apparently, that was about the only thing you knew. Were you always getting out after about a $100 loss?
Yes, although one trade lost almost $200. One was down to about $500 when John came up with an idea that was going to save the day. We would buy August pork bellies and sell February pork bellies because the spread was wider than the carrying charges. I vaguely understood the idea and agreed to the trade. That was the first time we decided to go out to lunch. All the other times we had been too busy scrutinizing the board. But we thought this was a can't-lose trade, so it was safe to leave. By the time we came back, I was just about wiped out. I remembered this feeling of shock, dismay, and incredulity. I will never forget the image of John. He was a very portly guy, with thick, opaque glasses going up to the quote board, pounding and shaking his fist at it, and shouting, "Doesn't anyone want to make a guaranteed profit?" Later on, I learned that August pork bellies were not deliverable against the February contract. The logic of the trade was flawed in the first place.
Had John ever traded before?
No,
So where did he come up with this story about doubling your money every 2 weeks?
I don't know, but after that trade, I was wiped out. So I told John that, in light of what happened, I thought I knew as much as he did, which was nothing, and that I was going to fire him. No more potato chips, no more diet soda. I'll never forget his response. He told me, "You are making the greatest mistake of your life." I asked him what he was going to do. He said, "I am going to Bermuda to wash dishes to make a trading stake. Then I am going to become a millionaire and retire." The thing that amused me was that he didn't say, "I'm going to Bermuda and take a job to make a trading stake." He was very specific. He was going to wash dishes to get his trading stake.
What eventually happened to John?
To this day, I have no idea. For all I know, he might be living in Bermuda as a millionaire because he washed dishes. After that, I managed to rustle up another $500 and placed a few silver trades. I wiped out that stake as well. My first 8 trades, 5 with John and 3 on my own, were all losers.
Did the thought ever enter your mind that maybe trading was not for you?
No, I had always done well at school, so I figured it was just a question of getting the knack of it. My father, who died when I was 15, had left $3,000 in life insurance, which I decided to cash in, despite my mother's objections. But I knew I really needed to learn something before trading again. I read Chester Keltner's books on wheat and soybeans, and I also subscribed to his market letter, which made trading recommendations. I followed the first recommendation, which was to buy wheat, and it worked. I think I made 4 cents per bushel on that trade. It was my first win and very exciting. Then between letters, the market fell back to my original buying price, so I bought it again and made another profit on my own. I felt I was beginning to develop a sense for trading. Even in the beginning, I liked the feeling of doing things on my own. What happened next was just sheer luck. I bought 3 contracts of December corn in the summer of 1970, based on a Keltner recommendation. That was the summer that blight devastated the corn crop.
Was that your first big win?
Yes. That trade combined with buying some more corn, wheat, and soybeans, partly on recommendations in the letter and partly on my own intuition. When that glorious summer was over, I had accumulated $30,000, a princely sum to me, having come from a middle-class family. I thought it was the best thing in the world.
How did you decide when to take profits?
I took some on the way up and some when the market started coming down. Overall, I cashed in very well.
So instinctively, you were doing the right thing even then?
Yes. Then that fall I attended graduate school in Worcester, Massachusetts, but I found that I didn't want to think about my thesis. Instead of going to class, I would often sneak down to the Payne Wibber office in Worcester to trade. I was having a great time. I made a little money, not a lot. I was shocked to find myself cutting classes frequently, since I had been a dedicated scholar at Johns Hopkins. I realized that the handwriting was on the wall, and in December 1st I dropped out of school and moved to New York. I stayed at the Y for a while. When people asked me what I did, I rather pompously told them that I was a speculator. It had a nice ring to it. In the spring of 1971, the grain started getting interesting again. There was a theory around that the blight had wintered over, that is, it had survived the winter and was going to attack the corn crop again. I decided I would be really positioned for the blight this time.
Was this Keltner's theory, or just a market rumor?
I think Keltner believed it too. I borrowed $20,000 from my mother, added it to my $30,000, and bet everything on the blight. I bought the maximum number of corn and wheat contracts possible for $50,000 in margin. Initially, the markets held steady because there was enough fear of the blight to keep prices up. I wasn't making money, but I wasn't losing it either. Then one day I will never forget this. There was an article in the Wall Street Journal with the headline, "More blight on the floor of the Chicago Board of Trade than in Midwest Cornfields. The corn market opened sharply lower and fairly quickly went limited down.
Were you watching the market collapse?
Yes, I was in the brokerage office watching the board as prices fell.
Did you think of getting out on the way down before the market was locked limit down?
I felt that I should get out, but I just watched. I was totally paralyzed. I was hoping the market would turn around. I watched, and then after it locked limit down, I couldn't get out. I had all night to think about it, but I really had no choice. I didn't have any more money and had to get out. The next morning, I liquidated my entire position on the opening.
Was the market sharply lower again on the opening?
No, not sharply, just about 2 cents.
How much did you lose on the trade by the time you liquidated?
I lost my own 30,000, plus 12,000 of the 20,000 my mother had lent me. That was my lesson in betting my whole wad.
What did you do then?
I was really upset. I decided I had to go to work. Since there was a recession at the time, I thought I probably couldn't get a really good job and should try to settle for a lesser position. I found that even though I interviewed for positions for which I was unusually well qualified, I couldn't seem to get any job. I finally realized that I couldn't get these jobs because I didn't really want them. One of the best job openings I found was a commodity research analyst slot at Reynolds Securities. I discovered that it was easier to get this better position because they could tell I really wanted it. I learned that if you shoot for what you want, you stand a much better chance of getting it because you care much more. Anyway, there was a glass partition between the office and the main office where the brokers sat. I still had the trading bug and it was very painful to watch them trading it, running it up.
What, you were just doing the research?
Right, because the analysts were strictly forbidden to trade. But I decided I wouldn't let that stop me. I borrowed from my mother again, my brother, and my girlfriend and opened an account at another firm. I worked out an intricate code system with my broker to keep people in my office from knowing that I was violating the rules. For example, if I said, the sun was out, that meant one thing, while if I said, the weather is cloudy, it meant something else. While I was trying to write my market reports, I kept peering out through the glass partition to see the prices on the big trading board in the main office. When I was winning, I tried to hide my elation, and when I was losing, I had to make sure not to let it show on my face. I don't think anyone ever caught on, but I was in a manic, depressive state throughout that time. I felt tortured because I wanted to be free to trade without going through this elaborate charade.
Were you making or losing money during this time?
I lost. It was the same old cycle of borrowing money and consistently losing it.
Did you know what you were doing wrong then?
Good question. Basically, I had no real grasp of trading principles. I was doing everything wrong. Then in October 1971, while at my broker's office, I met one of the people to whom I attribute my success.
Who was that?
Ed Sikota. He is a genius and a great trader who has been phenomenally successful. When I first met Ed, he had recently graduated from MIT and had developed one of the first computer programs for testing and trading technical systems. I still don't know how Ed amassed so much knowledge about trading at such an early age. Ed told me, I think you ought to work here. We are starting a research group and you can trade your own account. It sounded great. The only problem was that the firm's research director refused to hire me.
Why?
I couldn't imagine why, since I wrote well and had experience. When I pressed him for a reason, he told me, I can't hire you because you already know too much and I want to train somebody. I said, look, I will do anything you want. Eventually, I convinced him to hire me. It was really great because I had Ed to learn from, and he was already a very successful trader. He was basically a trend follower who utilized classic trading principles. He taught me how to cut my losses, as well as the importance of riding winners. Ed provided an excellent role model. For example, one time, he was short silver, and the market just kept eking down, a penny a day. Everyone else seemed to be bullish, talking about why silver had to go up because it was so cheap, but Ed just stayed short. Ed said, the trend is down, and I'm going to stay short until the trend changes. I learned patience from him in the way he followed the trend.
Did Ed's example turn you around as a trader?
Not initially. I continued to lose, even with Ed there.
Do you remember what you were still doing wrong at that time?
I think I wasn't patient enough to wait for a clearly defined situation.
Did you think of just tailcoating Ed because he was so successful?
No, I couldn't bring myself to do that.
Did you ever think of just giving up on trading?
I would sometimes think that maybe I ought to stop trading because it was very painful to keep losing. In Fiddler on the Roof, there is a scene where the lead looks up and talks to God. I would look up and say, am I really that stupid? And I seemed to hear a clear answer saying, no, you are not stupid. You just have to keep at it. So I did. At the time, I was befriended by a very kind, knowledgeable, and successful semi-retired broker Atchison named Amos Hostetter. He liked my writing, and we used to talk. Amos reinforced a lot of the things Ed taught me. I was getting the same principles from two people.
Were you making recommendations for the firm at the time?
Yes.
And how did the recommendations work out?
They were better because I was more patient. Anyway, I was totally out of money and out of people who would lend me money. But I still had a kind of stubborn confidence that I could somehow get back on the right track again. I was only making $12,500 a year, but I managed to save $700. Since that wasn't even enough to open an account, I opened a joint account with a friend, who also put up $700.
Were you totally directing the trading in this joint account?
Yes, my friend didn't know anything about the markets. This was in July 1972 and, at the time, we were under price controls. The futures market was supposedly also under price controls.
This was Nixon's price freeze?
Yes. As I recall, the plywood price was theoretically frozen at $110 per thousand square feet. Plywood was one of the markets I analyzed for the firm. The price had edged up close to 110, and I put out a bearish newsletter saying even though supplies were tight, since prices couldn't go beyond 110, there was nothing to lose by going short at 110.
How did the government keep prices at the set limits? What prevented supply and demand from dictating a higher price?
It was against the law for prices to go higher.
You mean producers couldn't charge more for it?
Right. What was happening though was that the price was being kept artificially low, and there is an economic principle that an artificially low price will create a shortage. So shortages developed in plywood, but supposedly the futures market was also under this guideline. However, no one was sure. It was sort of a gray area. One day, while I was looking at the quote board, the price hit 110. Then it hit $110.10, then 110.20 cents. In other words, the futures price was trading 20 cents over the legal ceiling. So I started calling around to see what was going to happen. But nobody seemed to 17 know.
Was plywood the only market exceeding its price freeze level?
Yes. Anyway, nothing happened. I think the market closed somewhere over 110 that day. The next day it opened at about $110.80. Point one used the following reasoning. If they let it trade over $110 today, they might let it trade anywhere. So I bought one contract. Well, ultimately, plywood went to $200. After I bought that first contract, and prices rose, it was just a matter of pyramiding and riding the position.
Was that your first really big trade after you had been wiped out in the corn market?
Yes.
Did the cash plywood market stay at $110?
The futures market functioned as a supply of last resort to users who couldn't get supplies elsewhere.
Basically, it created a two-tiered market, a sort of legal black market.
Yes. Those who were frozen out because they didn't have any long-standing relationships with producers could get their plywood at a higher price in the futures market. The producers were fuming at the thought that they had to sell at the legal price ceiling.
Why didn't producers just sell futures and deliver against the contract as opposed to selling in the cash market at the price control level?
The smarter ones were learning that. But it was the infancy of futures trading in plywood, and most producers weren't that sophisticated. Some producers probably weren't sure that it was legal to do that. Even if they thought it was, their lawyers might have told them, maybe people can buy plywood at any price in the futures market, but we better not sell and deliver above the legal ceiling. There were a lot of questions.
Did the government ever try to interfere with the futures markets?
Well, not exactly, but I will get back to that. In just a few months, $700 had grown into $12,000 trading plywood.
Was this the only trade you had on?
Yes. Then I got the bright idea that the same shortage situation was going to occur in lumber. I bet everything on one trade just as I had on the corn and wheat trade, expecting that lumber would also go through the ceiling price.
What was lumber doing at this time?
It did nothing. It just watched plywood go from $110 to $200. Since they were both wood products, and lumber was also in short supply, I reasoned that lumber could go way up, and it should have. However, after I bought lumber at around $130, the government finally woke up to what had happened in plywood, and they were determined not to let the same thing happen in lumber. The day after I went long, some government official came out with an announcement that they were going to crack down on speculators in lumber who were trying to ran up the market like they had plywood. The lumber market crashed just on that statement. I was down to the point where I was close to being wiped out again. There was a 2-week period during which they kept issuing these statements. The market stabilized at a level just above where I would have been wiped out. I had just enough money left to hang on to my position.
The market stabilized at a level just above where I would have been wiped out. I had just enough money left to hang on to my position.
About $117.
So even though the magnitude of this decline was much smaller than the price rise in plywood, you lost almost as much money because you had a much larger position in lumber than you had in plywood.
Right. During those 2 weeks, I was constantly on the verge of being wiped out. It was the worst 2 weeks in my whole life. I went to the office each day just about ready to give up.
Giving up just to stop the pain, or so that you would at least have something left?
Both. I was so upset that I couldn't stop my hands from shaking.
How close did you come to being wiped out again?
Well, my $12,000 had shrunk to under $4,000.
Did you say to yourself, I can't believe I have done this again?
Yes, and I never did it again. That was the last time I bet everything on one trade.
What eventually happened?
I managed to hold on, and the market finally turned around. There was a shortage, and the government didn't seem to have the will to stop the futures market.
Was it insight or courage that gave you the willpower to hold on?
Desperation, mainly, although there was a support point on the charts that the market couldn't seem to take out. So, I held on. At the end of that year, the $700, which I had ran up to over $12,000 and back to under $4,000, was now worth $24,000. After that scary experience, I never really overtraded again. The next year, 1973, the government began lifting the price controls. Because the price controls had created numerous artificial shortages, when they were lifted, there was a tremendous run-up in many commodities. Just about everything went up. Prices doubled in many markets, and I was able to take advantage of the tremendous leverage offered by low futures margins. The lessons I had learned from Dakota about staying in markets with major trends really paid off. In 1973, my account grew from $24,000 to $64,000.
At that time, we were seeing something completely new. I remember those markets. Even after prices had gone up only 10% of their eventual advance, historically, it seemed like a very large price move. What made you realize that prices could go so much further?
At the time, I was politically right-wing, and that fit with being an inflation alarmist. The theory that the evil government was constantly debasing the currency provided the perfect perspective for trading the inflationary markets of the mid-1970s.
It was the right theory for the right time.
Right. The markets were so fertile for trading then that I could make plenty of mistakes and still do well.
Trading strictly on the long side.
Yes. Everything was going up. Although I was doing very well, I did make one terrible mistake. During the great soybean bull market, the one that went from $3.5 to nearly $12, one impulsively took my profits and got out of everything. I was trying to be fancy instead of staying with the trend. Ed Dakota never would get out of anything unless the trend changed. So it was in while I was out, and I watched in agony as soybeans went limit up for 12 consecutive days. I was real competitive, and every day I would come into the office knowing he was in and I was out. I dreaded going to work because I knew soybeans would be bid limit again and I couldn't get in.
Was this experience of not being in a runaway market as aggravating as actually losing money?
Yes, more so. It was so aggravating that one day I felt I couldn't take it anymore and I tried tranquilizers to dull the mental anguish. When that didn't work, somebody said, "Why don't you take something stronger, called Thorazine?" I remember taking this Thorazine at home and then getting on the subway to go to work. The subway doors started to close as I was getting on, and I started to fall down. At first, I didn't connect it with the Thorazine. Anyway, I wandered back home and just fell through the doorway. It was that strong. It knocked me out and I missed work that day. That was the low point in my trading career.
You never threw in the towel and just went back into soybeans at some point.
No, I was afraid of losing.
Despite that mistake, you mentioned before that you built your account up to $64,000 by year end. What happened next?
Around that time, I would occasionally have to go over to the cotton exchange. I would have an adrenaline rush when I heard the traders yelling and screaming. It seemed like the most exciting place in the world. But I learned that I needed to show $100,000 net worth to get in. Since I had virtually no assets outside of my commodity account, I couldn't qualify. I continued to make money in the markets, and after several months, I had surpassed the $100,000 mark. Around that same time, Ed Sakota recommended that I go long coffee. So I did, but I put a close stop in under the market just in case it went down. The market turned down, and I was stopped out quickly. Ed, however, because he was a major trend follower, had no stop-in and ended up being locked in a limit-down market for several days in succession. Each day, Sakota was locked in a losing position while I was out of the market. That was the exact opposite situation of the soybean trade, when he was in a winning trade and I was out. I couldn't help it, but I felt a sense of joy. I asked myself, what kind of a place is this that one's greatest joy is to be found when somebody else is getting screwed? That was the point I realized that what I was doing was too competitive, and I decided to become a floor trader at the New York Cotton Exchange.
It sounds like the floor would have been even more competitive.
Well, maybe, but it wasn't.
Did you have any concern about being a floor trader, the fact that you were now reducing your field of opportunity down to one market?
I was a little concerned about it. As it turned out, I should have been very worried. However, the thought of trading in the ring was very exciting to me. The truth of the matter was that while I was very good at picking trades, I was a total bust at the execution part. I was very shy, and I was too timid to yell loud enough to make myself heard on the floor. I ended up slipping my orders to a floor trader friend of mine who handled them for me. That went on for a few months until I realized what I was doing.
Were you still approaching the markets as a position trader even though you were on the floor?
Yes, but it was just out of timidity.
So, I assume that many days you weren't even trading.
Right.
Was there any advantage to being on the floor?
No, not for me. But I did learn a lot from the experience, and I would recommend it to anybody who wants to become a better trader. I used what I learned there for years.
What type of things did you learn?
You develop an almost subconscious sense of the market on the floor. You learn to gauge price movement by the intensity of the voices in the ring. For example, when the market is active and moving, and then gets quiet, that is often a sign that it is not going to go much further. Also, sometimes when the ring is moderately loud and suddenly gets very loud. Instead of being a sign that the market is ready to blast off, as you might think, it actually indicates that the market is running into a greater amount of opposing orders.
But how do you use that type of information once you are at the floor? You said that the things you learned on the floor helped you later on.
I learned the importance of intraday chart points, such as earlier daily highs. At key intraday chart points, I could take much larger positions than I could afford to hold, and if it didn't work immediately, I would get out quickly. That was because, by being on the floor, I had become familiar with how the market responded to those intraday points. My trading in those days was a little bit like being a surfer. I was trying to hit the crest of the wave just at the right moment. But if it didn't work, I just got out. I later used that surfing technique as a desk trader. Although that approach worked real well then, I don't think it would work as well in today's markets.
Is that because the markets have become choppier?
Right. In those days, if the market reached an intraday chart point, it might penetrate that point, take off, and never look back. Now it often comes back.
So what is the answer?
I think the secret is cutting down the number of trades you make. The best trades are the ones in which you have all three things going for you: fundamentals, technicals, and market tone. First, the fundamentals should suggest that there is an imbalance of supply and demand, which could result in a major move. Second, the chart must show that the market is moving in the direction that the fundamentals suggest. Third, when news comes out, the market should act in a way that reflects the right psychological tone. For example, a bull market should shrug off bearish news and respond vigorously to bullish news. If you can restrict your activity to only those types of trades, you have to make money in any market, under any circumstances.
Is that more restrictive trading style the approach you eventually adopted?
No, because basically I enjoyed the game too much. I knew that I should only be in those optimum trades, but trading was a release and hobby for me. It replaced a lot of other things in my life. I placed the fun of the action ahead of my own criteria. However, the thing that saved me was that when a trade met all my criteria, I would enter 5 to 6 times the position size I was doing on the other trades.
Were all your profits coming from the trades that met the criteria?
Yes,
Were the other trades breaking even?
the other trades broke even and kept me amused,
Did you keep track of which were which so you knew what was going on?
just mentally. My goal on the other trades was just to break even. I knew that the big money was going to be made on the trades that met my criteria. There will always be trades that meet those requirements, but there may be fewer of them, so you have to be much more patient.
Why are there fewer such trades? Has the marketplace gotten more sophisticated?
Yes, there are many more professional traders than in my early days. In those years, I had an edge just by knowing the angles that Ed Secoda and Amos Hostler taught me. Now everybody knows those principles. You have trading rooms filled with bright people and computers. In those days, you watched the board, and you would buy corn when it moved above a key chart point. An hour later, the grain elevator operator would gel a call from his broker and he mile by. The NEXL day, our brokerage house would recommend the trade, pushing the market up some more. On the third day, we got short covering from the people that were wrong, and then some fresh buying from the dentists of the world, who finally got the word that it was the right time low buy. All that lime, I was one of the first ones to buy because I was one of the few professional traders playing the game. I would wind up selling out low the dentist several days later.
You're talking about short-term trades. Weren't you trading for the major moves?
I traded some major moves, but many times I would make my profits in 2 or 3 days in just that kind of trade.
When did you get back in the market?
Well, the dentists weren't all going to keep their positions, since they were buying at the wrong time. So when the market would fall back, I would go back in. Nowadays, the moment the market breaks a key chart point, it is perceived by a whole universe of traders.
So the lagged follow-up trades are no longer there.
Right, the grain elevator operator has already bet. The dentists don't count because their level of trading participation is infinitesimal.
Is that because they now have their money invested with fund managers instead of trading by themselves?
Right, and even if the dentists are still there, they are trading one lots, which is a meaningless position when the fund managers are trading 1,000 at a clip. Now you almost have to be contrary. You have to ask, isn't it true that all my fellow professional traders are already in, so who is left to buy? You didn't have to worry about that before, because there was always somebody left to buy the people who were getting the information or reacting slower. Now, everybody is just as decisive, just as fast.
Are the markets more prone to false breakouts now?
Yes, much more.